statement of financial position. In this video, we're going to look at what is meant by the term statement of financial position, what information is enclosed in the statement of financial position, and how it can be used with some of the ratios from liquidity to make decisions about how a business is performing. So the statement of financial position shows us the assets and liabilities of an enterprise, or it tells us what the overall value of an organisation is. It shows us our assets and our liabilities and can be used to show worth. Remember that. An asset is an item which a business owns, and the opposite of an asset is a liability. And a liability is something that a business owes. So you want to have more assets than liabilities. So let's take a look at a completed statement of financial position. As you can see on the right hand side of your screen, I've highlighted and shaded in the calculation boxes. However, it shows information on the fixed assets, information on the current assets, and information on the current liabilities. Fixed assets are items that you own that may take longer than a year to turn into cash. They typically be the one-off or the expensive purchases you make, like your machinery or your building. Your current assets, now the word current means within a year, so these are assets that you can turn into cash within a year. The best asset you can have is the cash in the bank because you can use it instantly. However, you may have inventory, which is another word for stock, and then you have debtors, people who have a debt to you, people who you've given time to pay, maybe 30 days for example. And then you have information on your current liabilities, and again the word liability means people who you owe money to, and the word current means within a year. So these are debts that you've got to pay within a year. Typically you have your overdraft, then you have creditors. They are people who've given you chance to pay and time to pay, typically your suppliers. Towards the bottom of the statement of financial position, you will see the column net current assets. Now, net current assets is the amount of money that a business has available to be able to pay its current obligations, the word current. And it's calculated by doing your current assets take away your current liabilities. And this is something that you need to remember to do as a formula. So in my case here, you have to find your total current assets and then you have to subtract it from your total current liabilities. And then you can see there, I get my net current assets. At the bottom of your statement of financial position, you will find the column net assets. And the word net in maths means total. So this is basically the total value of your business or everything that it's worth. And the way you calculate this is simply taking your net current assets that you just calculated and add it on to your total fixed assets that you've worked out previously near the top. So in my case here, you would take that £250,000 that you've got for your total fixed assets and you add that to your £53,000 that you have for your net current assets. And that is the overall value or worth of the organisation. Now you can use the information that you've got in your statement of financial position to do some liquidity ratios. Remember, liquidity is working out the availability of money in the business. And one of the ratios we can do is the current ratio. Now the current ratio compares the current assets to the current liabilities. And it looks at how able a business is to meet its current obligations. You quite simply do a division of the current assets divided by your current liabilities. In my example here, that would be 110,000 divided by 57,000. And that would give me an answer of 1.9. Now, normally you'd write the ratio down as 1.9 to 1. However, you would get the mark for just writing 1.9 down. But it's important to understand what that means. And what that means is that for every £1 of liabilities, current liabilities that you've got, so what you owe in the short term, you've got £1.90 in current assets. So in theory, that's really good because the business has got more current assets than current liabilities. Now, there is another ratio that we can use, and that's called the liquid capital ratio. And this is because some people in the world of accountancy don't like to include inventory or stock as part of your current ratio. So what they want to do is they want to take away the stock from the current assets because they say that if you've got lots of stock and your money's tied up in stock, then if you want to sell it quickly, you're going to need to reduce it. So you won't actually get the value of the inventory that you think, plus your stock can go out of fashion. So the liquid capital ratio compares your current assets minus your inventory divided by your current liabilities. So in my example here, it'd be £110,000 minus my £25,000, and then I would divide that figure by 57,000, and that would give me an answer of 1.5, or again I might express it as 1.5 to 1. And what that means is that for every £1 that the business owes in the short term, it's got £1.50 in current assets without stock being included. So that's clearly good because I've got more money to be able to pay my current liabilities and I've not even factored in my stock. So let's take a quick recap looking at the keywords that you should now know. So you need to understand that your statement of financial position shows the assets and liabilities of an organisation and the value or the worth of the organisation. You need to understand that an asset is an item that a business owns. You need to understand that a liability is something that the business owes. You need to understand that fixed assets are assets that the business owns or items the business owns that can be turned into cash in longer than a year. A current asset is an item that a business owns that can be turned into cash within a year. You should also know that cash, debtors, and inventory are all examples of current assets. You should be aware that current liabilities are debts that a business has to pay within a year. You should be aware that an overdraft and creditors are people that form part of your current liabilities. You need to be aware that debtors are people who have a debt to you, so they owe you money. And you need to be aware that creditors are people who you owe money to, typically your suppliers. You also need to be aware that the term inventory is another term for stock. You need to make sure you understand that net current assets is the ability to pay your current debts at the moment, and it's calculated by doing your current assets minus your current liabilities. And you need to be aware that your net assets is a word for your total value of the organisation, and it's calculated by doing your total fixed assets plus your net current assets. Hopefully they make sense and you understand all the key terms. Don't forget to give me a follow on my socials and make sure you keep buzzing.